Hello everyone, Dr. Trussell here, and today we're going to be talking about Chapter 13 from the textbook, Current Liabilities and Contingencies. So sit back and relax, take some good notes, and let's go for a ride. The first question to ask is, what are the essential characteristics of a liability? In the little chart here, the little picture, it says that liabilities are amounts owed to creditors, that is vendors and lenders. That's a little bit of a simplistic version of it, so we have a more technical explanation. So liabilities are probable future sacrifices of economic benefits. All right, so what are we saying there? So probable future sacrifices. That means they're likely to occur. In the future, we're going to sacrifice what? Economic benefits. And economic benefits are what? They're assets. So we're saying that we are going to sacrifice assets in the future. We're likely going to do that. And they arise from present obligations to transfer assets or provide services to other entities. So we're going to give up assets. Why? Because we have a present obligation. That is something that already exists. We have an obligation to do what? Transfer assets, say cash for example, or provide a service to another entity. And those liabilities result from past transactions. So they have to already have taken place. Whatever gave rise to this future sacrifice had to have taken place. For example, we bought supplies on account. So the transaction purchasing the supplies has already taken place. And so we're going to have to sacrifice assets, paying cash in the future based on what we owe now, and it's from a past transaction, that is buying these supplies on account. Well, in this chapter, we're going to specifically look at current liabilities compared to non-current liabilities. In the future chapters, we'll be looking at non-current liabilities. So we have a working definition, one that we can use most often, and that is obligations payable within 1 year or within the firm's operating cycle, whichever is longer. So typically, if we owe something within a year, that's considered current. But we have a technical definition too. Obligations to be expected to be satisfied with current assets or by the creation of other current liabilities. So for example, what I said before, buying supplies on account, we're going to satisfy that by paying cash, which is a current asset. Examples include accounts payable, notes payable, salaries payable, interest payable, taxes payable, deferred revenues. Those are all examples of current liabilities. However, notes are a little bit trickier because those could also be non-current. Because non-current or long-term liabilities, those would be items that are due longer than a year, or we're not expected to be satisfied with current assets, and so notes could be there too. So notice that notes can be in either category depending on when they're due. But notes, bonds, pensions, leases, and deferred tax liabilities. We are going to talk about all of these non-current liabilities in future chapters. For example, notes and bonds we're going to cover in chapter 14, pensions in chapter 17, leases in chapter 15, deferred taxes in chapter 16. So we will see all of these things in this course. So accounts and notes payable, they're very similar, so let's talk about how they're different. Those are the two most common current liabilities that companies have. So what's the difference? They're very similar, but accounts payable tend to be from suppliers or vendors, many times without interest. So buy supplies on account from your supplier. Notes tend to be from financial institutions and typically, but not always, charge interest. How to compute interest expense on an interest-bearing note? Well, there's a formula. We have face amount, which is also called the principal, times the annual rate times time. Another way of saying that same thing would be face amount or principal times your rate and then times time. And I like it that way because PRT is like PERT, so it helps you to remember it. How do you compute interest expense on a non-interest bearing note? Well, you take, with a non-interest bearing note, you're going to end up with what's called a discount. Take the discount and divide it by the number of periods. Well, how is it possible to have interest expense if the note has no interest? Well, interest is implied from the face amount less the amount received. So basically, what they do is say you get a note of $10,000, but they only give you cash of $9,000. So the $1,000 difference is implied interest. It's not explicit, but it's implied in that they're taking the interest out up front. So that's what they call a discount, and then you amortize that over the number of periods. What about other types of current liabilities? Well, commercial paper is one, and commercial paper is just basically another kind of note. It refers to unsecured notes sold in minimum denominations of $25,000 with maturities ranging from 30 to 270 days. So it's a type of note. What's a line of credit? It is an agreement to provide short-term financing with amounts withdrawn by the borrower only when needed. Kind of like your credit card. If you get a credit card, you'll have a line of credit of say $1,000, and you don't have to borrow that, but you can borrow up to that amount. How do we value short-term notes on the balance sheet? How about long-term notes, and why are they treated differently? Short-term notes we put on the balance sheet at maturity value, which is the amount that you owe. But long-term notes we value on the balance sheet at present value. That is, we take out the time value of money, and therefore it's less the implicit interest. They both should be at present value, but normally when you discount a short-term note, the interest impact is immaterial. That is really small. So basically the FASB says we'll just ignore that difference. Makes it a little bit easier. Accrued liabilities are another type of current liabilities. And these are basically expenses that have been incurred, but we haven't paid for them yet. They would include things like accrued interest payable. That's interest that's been accrued or incurred during the period, but it's not yet paid. So interest is a time concept, so it accrues every day. So we come to the end of the accounting period, even if we haven't paid that interest, we still accrue it. That is, we account for it. Salaries payable would be salaries that have been incurred but not yet paid. We have workers that work this period, but we don't pay for them till the next period. According to accrual accounting, we have to record those as salaries payable. Compensated absences, and when do we accrue them? Basically, compensated absences are when employees receive compensation even though they don't work, such as vacation pay and sick days. So every day, you say you might get 2 weeks of vacation a year, but you earn those over time. So the question is, if you don't take that vacation this period, do we have to record that as a liability? And the answer is, it depends. So the circumstances that we accrue them are laid out in this little table right here. The obligation is attributable to the employee's services already performed. So you've already done the work to accrue those, that account towards those vacations. The paid absence can be taken in a later year. That means the benefits vest. So you'll be compensated even if employment is terminated, or the benefit can be accumulated over time. As opposed to you'll use it or lose it policy. Some places, if you don't take your vacation this year, you just lose it. So there we don't have to accrue for it. Number 3, the payment is probable. That is, you're likely going to have to make that payment, and we can reasonably estimate the amount. We know how much that you have accrued over time. In those cases, we have to accrue for compensated absences, vacations payable, sick days payable. Advanced collections. Advanced collections excuse me, are payments from customers that will be applied towards the purchase price when the goods are delivered or services provided. So the customers pay us in advance. What's the liability? We owe them the good, or we owe them the service. So if they pay us in advance of delivering the goods or providing the service, then we have advanced collections, and that is a liability because we owe them that service. Examples include gift certificates, magazine subscriptions, layaway deposits, special order deposits, airline tickets. You buy an airline ticket, it's not revenue to the airlines until you actually fly. Why are advanced collections considered liabilities, which we sometimes call deferred revenue or unearned revenue? Because they represent liabilities until the product or service is provided or delivered. Well, how do we determine current versus non-current or long-term classification of notes? Well, let's say that you have a long-term note, but a portion of it is due next year. How do we account for the current portion of that long-term debt? Well, it is accounted for as a current liability because that portion is due within 1 year. So for example, you owe a mortgage on a house. Some of it is due next year, the rest of it is due many years after that. So the amount that's due next year, we're going to split apart that long-term debt between current and non-current. How about circumstances when we reclassify short-term notes into long-term liabilities related to refinancing? So it's short-term obligations that are expected to be refinanced on a long-term basis can be reported as non-current rather than current liabilities. What are we saying here? So you have a current, let's say, note. You have a note payable. It's due in a couple of months. But you realize that you're short on funds, and so you're going to refinance that note with a long-term note. So you can, under certain circumstances, reclassify that current note payable into a long-term note payable. You can do that if 2 criteria are met. So if these 2 criteria are met, you can take that short-term note and call it long-term, even though right now it's still short-term. The firm and the 2 criteria are intent and ability. So the firm must intend to refinance on a long-term basis, and the firm must actually have demonstrated the ability to do that. You can demonstrate that either by an existing financing agreement, you have a contract with a bank to refinance, or by actually refinancing prior to the issuance of the financial statements. Let's go through some examples. The following selected transactions relate to the liabilities of AAA Corporation. The fiscal year ends December 31st. We are to prepare the appropriate journal entries through the maturity of each liability. So January 13th, 2016, negotiated a revolving credit agreement with Parish Bank that can be renewed annually upon the bank approval. The amount available under the line of credit is $20 million at the bank's prime rate. Again, that's kind of like getting a credit card. Until you actually borrow against it, that's not a liability. February 1st, arranged a 3-month bank loan of $5 million with Paris Bank under the line of a credit agreement. Interest at the prime rate of 10% was payable at maturity. So now you've actually borrowed money against that credit limit. Now we have a note payable. On May 1st, we paid that note off. And then December 1st, we have a separate note supported by the line of credit, issued at $10 million of commercial paper on a 9-month note. Interest was discounted at an issuance at a 9% discount rate. Recorded any entries, adjusting entries on December 31st, and next September 2017 we paid off that commercial paper. Let's go through the journal entries. First of all, when we issued the line of credit, when we received the line of credit from the bank, there's no formal entry. We have what's called a memorandum entry, and we would also describe that in the disclosure note to the financial statements. On February 1, when we issued the note, we debit cash, credit notes payable. Fairly straightforward. This is an interest-bearing note. When we paid off the note, we pay back the note with principal plus interest. Remember the formula for interest expense: principal or face amount times time, times rate times time. The time is the number of periods in this year, and then a number of months in this year divided by 12. So because 10% is an annual rate, we need to divide it by 12 to get it into a monthly rate, and then multiply by the number of months in the year. So 3 out of 12 months. And then we pay the cash back with principal plus interest. December 1st, we issued the commercial paper on a discounted basis. That is, we're not getting, in essence, they're taking out the interest up front. This is like almost like a non-interest bearing note, but in this case, that the rate, the discount rate is different than what we actually owe. So we are taking the discount out. We take the face value times the discount rate times the number of periods related to the note, with 9 months out of 12. It was a 9-month note. And so that difference goes into account. That's not the interest. That's interest over time. So we put it in this account called discount on notes payable. That account is a contra liability. Discount notes payable is a contra liability. Kind of like we had contra assets like accumulated depreciation. Contra just means opposite balance. Notice it has a debit balance, opposite of the normal balance of a liability, which is a credit. All right, we need adjusting entries, and we need to have adjusting entries on that note that we just recorded. The other note we paid off. This is the commercial paper, and remember what we do. We take the total discount and we multiply it by the number of periods total. So 9 is the total number of months for the entire loan. 1 is the number of months in this period. So December 1 through December 31st is 1 month out of the total 9 months. And notice that we do not credit cash because we're not paying cash. We already paid the cash up front. So what we're doing is writing off what they call amortizing the discount. And then we go to pay off the note. First of all, we have to record the rest of the interest or amortize the rest of the discount. So here's the other 8 out of the 9 months. And then we're ready to pay off the note. Looks a little bit different than the interest-bearing note, because the interest-bearing note we paid interest at the end. This note we paid interest up front. Next, we're going to talk about loss contingencies. What do we mean by loss contingencies? Well, it's an existing uncertain situation involving a potential loss, depending on whether some future event occurs or doesn't occur. So, for example, a potential loss would be for like a warranty claim. So the customer has a warranty and they may or may not bring back in that item for warranty work. So it's a potential loss depending on future event occurs or doesn't occur. What's a future event? That is the customer brings back the item for warranty work or doesn't bring it back. What are the conditions to consider for properly accounting for that loss contingency? Whether a loss contingency accrued and reported as a liability depends on two things: the likelihood that the confirming event will occur, the likelihood that the customer will bring back the goods for warranty claims, and what can be determined about the amount of the loss. Can we get an estimate of that loss? Three types or categories of loss contingencies: product, warranty, or guarantees. So anytime you're selling a good, it has a product, then you have a potential loss. Let's have a product that has a warranty. You have a potential loss, customers bringing back that item for warranty work. Litigation claims, you're being sued, and its contingency is whether or not you lose. If you lose, you have the loss, so your potential loss is paying out on that claim. Subsequent events, which would be events that happen after the end of the year that may impact the current year. So the question is, how do we account for loss contingencies? Well, we're either going to accrue, which means actually record a liability, book a liability this year. Disclose, which just means put it in the notes to the statements. Disclose it, make it aware. Don't accrue, just make a note. Or we do neither. Basically, we do nothing. So we said it depends on two things: the likelihood of occurrence. How likely is it that we're going to lose a lawsuit, for example? And then the dollar amount of the potential loss. So the likelihood, it's either probable, meaning very likely that we're going to, say, lose a lawsuit, or at the other end of the extreme, it's remote, very unlikely we're going to lose it. And then they have this middle category. It's sort of in between likely and unlikely, sort of in the middle somewhere. And then the dollar amount of loss, we either know it, maybe we settle a lawsuit, or we can get a reasonable estimate, or we do not have a reasonable estimate. And so the different possibilities are, if it's known and probable, then we have to accrue a liability and disclose it. So I would accrue a liability for the lawsuit and disclose it in the notes. Same thing is true if I have a reasonable estimate and it's probable. But if it's probable and I have no reasonable estimate, I have to only disclose it. That's because if I don't have a reasonable estimate, I don't have a number to assign to a journal entry, so I can't record it. Let's go to the far end of the spectrum. If it's remote, if the likelihood of occurrence is remote, meaning unlikely to occur, it's unlikely we're going to lose that lawsuit, it's unlikely customers are going to bring back their goods for service, for warranty service, then it doesn't matter about the potential loss. We're always going to basically do nothing. Because the chances are so remote, there's no need to address it either by accruing or disclosing. And then the middle category, which is this reasonably possible in likelihood of occurrence, well, because it's not probable, the rules say that all we have to do is disclose it. So I will just disclose it. I will not accrue it though. So you see there's only two cases when we actually accrue, and that are these two boxes here. So it has to be probable and either known or reasonably estimated, then we will accrue. What about gain contingencies? What do we mean by that? So how does GAAP treat gain contingencies? Why are they treated differently than loss contingencies, and what's an example? Well, a gain contingency is an uncertain situation like the loss contingency, but it might result in a gain. So what if we're suing someone and that we might get some money coming in? Gain contingency under US GAAP are not accrued. Basically, that's because it's conservative to wait till they actually take place. Material ones are disclosed in the notes to the financial statements. Only highly material ones are disclosed if they are probable. And then an example is in a pending lawsuit, one side, the defendant, faces a loss contingency. Other side, the one doing the suing, has a gain contingency. So we might be on the plaintiff's side and we could have a gain contingency. Well, here's an example of these contingencies. This is a warranty example. Cupola Awning Corporation introduced a new line of commercial awnings in 2016 that carry a 2-year warranty against manufacturer's defects. Based on their experience with previous product introductions, warranty costs are expected to approximate 3% of sales. Sales were $5 million and the actual warranty expenditures were $37,500 for the first year of selling the product. Does this situation represent a loss contingency? Why or why not, and how should they account for it? Well, yes, this is a loss contingency because they have a potential loss, which is the outflow related to satisfying the warranty costs, and they're in the future, and it's dependent on whether the customers bring back their goods or not. And how should we account for it? Well, because it's probable that at least some will bring back their goods, and we have a reasonable estimate because it says 3% of sales as a reasonable estimate. So let's make the journal entries that summarize the sales of the awnings, assuming credit sales, and any aspects of the warranty that should be recorded. So the sales, all on account, typical way we record sales, debit accounts receivable, credit sales, and then the actual liability and the expense. First of all, this is the accrued, this is the loss contingency. So we are recording 3% of the sales as warranty expense, but it's not going to be paid out till later, so it's put into an estimated warranty liability. And then when we make actual payments, actual expenditures, we're going to debit that warranty. So notice that the warranty, when we actually pay off something, we're coming out of the warranty liability and not warranty expense. And then it doesn't say how they paid it out, so it could be cash, it could be labor, it could be part supplies, etc. We're going to do another example that has several parts. These are all related to contingencies from lawsuits. Erasmus is defending against a lawsuit. Management believes the company has slightly worse than 50-50 chance of eventually prevailing in court. And if it loses, the judgment will be $1 million. Okay, what should we do? Well, to be accrued, it has to be probable. And so since it's in this area of almost an equal chance of winning and losing, we would probably call that reasonably possible and not probable. Probable needs to be up in the 75% plus range for it to be considered probable. And so we do have a reasonable estimate, but since it's not probable, what are we going to do? We would likely not accrue, because GAAP defines probable to be a likelihood substantially more likely than not. So again, up in the 75%. And then they would probably call that reasonably possible, and therefore all we need to do is disclose. Remember, we said if it's reasonably possible, then we would just need to disclose. Example number 2, they're defending against a lawsuit. Management believe it's probable the company will lose, and if it loses, the damages would fall anywhere in the range of 2 to 4 million, with any damage in that range equally likely. Okay, so what are the two criteria? It has to be probable, which they said it is, and they have to have a reasonable estimate, which they do. They said the estimate is 2 to 4 million. But when you record a journal entry, you can't put 2 to 4 million, you have to put one number. Well, US GAAP requires that we use the lower of the ranges. So therefore, they would recognize a liability of $2 million because it's probable, and US GAAP requires accrual at the low end of a range. And of course, we would also put note disclosure, so we would accrue and disclose. Here is example 3, part 3. They're defending against a lawsuit. They believe it's probable they will lose in court. So we've met the probability requirement. If it loses, they believe that the damages will eventually be 5 million and the present value 3.5 million. So it's probable, they have a reasonable estimate, but then the question is, do they accrue the 5 million or the present value of that? Well, normally the rule is for a long-term liability recorded at present value, but GAAP does not require that for contingencies for some reason. So they would recognize a liability of 5 million as it's probable they will lose the case. Under US GAAP, companies typically do not discount the litigation claims for the time value of money. There will also be a note disclosure of the lawsuit. Accrue and disclose at the undiscounted amount. IFRS is a little bit different. Under IFRS, they would use the present value. Part 4. They're plaintiff in a lawsuit. Management believes that probable the company eventually prevail in court, and if it prevails, the judgment will be $1 million. Okay, so first of all, notice that they're a plaintiff. So they are suing someone else. If they win, they'll get $1 million. So here's the problem. What do we call this? A gain contingencies. Gain contingencies are not accrued under US GAAP. But since it's material, they would probably have a disclosure note. And here's our last example. They're a plaintiff. Again, we're a plaintiff. Believes it's virtually certain the company will prevail in court, and if it prevails, there will be judgment of $500,000. Well, same thing. It's a gain contingency. It doesn't matter if they're virtually certain or not. Gain contingency are not accrued. Well, let's compare US GAAP versus IFRS with contingencies. So IFRS defines probable as more likely than not, which just means greater than 50%. That's a lower threshold typically associated with probable in US GAAP, which is probably closer to 75%. So it's a lower threshold for meeting that. And if there is a range of equally likely outcomes, like we saw in that one case, IFRS would use the midpoint. US GAAP uses the lower end of that range. And if the effect of the time value of money is material, IFRS requires a liability stated at present value. Liabilities for loss contingencies like litigation typically are not discounted for the time value of money under US GAAP. Gain contingencies. Under IFRS, gain contingencies are accrued if the future realization is virtually certain. So in that last example, they would accrue it. But under US GAAP, gain contingencies are never accrued. Let's do some multiple choice questions as practice. Which of the following best definition of a current liability? An obligation to pay within 1 year, an obligation payable 1 year of the balance sheet date, an obligation payable with 1 year or within the normal operating cycle, whichever is longer, or an obligation expected to be satisfied by current assets, the creation of other current liabilities. Well, C is our working definition, but it's not the best definition. It's not the technical definition, and the technical definition is D. Which of the following is not a liability? An unused line of credit, estimated income taxes, sales tax collects customers, or advances from customers? Well, all of them except A. A is not, because it's unused. That's like getting your credit card, but you haven't used it yet. You're not going to get a bill because it's not yet a liability. Current liabilities are normally recorded at what? Present value, cost, maturity amount, or expected value. Well, we said before, current liabilities are normally recorded at their maturity amount. Some more multiple choice. A discount on a non-interest bearing note payable is classified in the balance sheet as what? It is an asset, a component of stockholders' equity, a contingent liability, or contra liability. Well, since it has the opposite balance of a normal liability, it's going to be recorded as a contra liability. Universal Travel borrowed $500,000 on November 1st and signed a 12-month note bearing interest at 6%. Interest is payable in full at maturity on October 31st, 2019. In connection with this note, they should report interest payable at December 31st in the amount of. So what we need to do is accrue a liability for interest payable that accrues from November 1st through the end of the year, December 31st. So that's November and December, that's 2 months. Remember our formula, principal, which is the 500,000 times rate, 6%, times time, 2 months out of 12. So therefore the answer is C, $5,000. Principal, 500,000 times rate times time. May 2018, Raymond Financial Services became involved in a penalty dispute with the EPA, Environmental Protection Agency. That's a tough gang there. December 31st, the environmental attorney for Raymond indicated that an unfavorable outcome was probable. So what we have here is a contingent liability that's probable. Additional penalties estimated to be $770,000, but could be as high as $1,170,000 after the end of the year, but before the 2018 financial statements were issued. Raymond accepted an EPA settlement offer of $900,000. Raymond should have reported on its accrued liability on December 31st, 2018 balance sheet of. Okay, so it's a contingent liability. It's probable. They have a reasonable estimate. Now, some of you might think the answer would be the 770 because it's on the low end of that range. However, this is a little bit different because we actually know the amount. Since we know the amount is $900,000, we knew that because the financial statements have not yet been issued. So therefore, we are able to accrue the amount $900,000. Number 7, December 31st, 2018, L Inc. had a $1,500,000 note payable outstanding due July 31st, 2019. So this is a short-term note payable. L borrowed money to finance the construction of a new plant. They planned to refinance the note by issuing long-term bonds. Because L temporarily had excess cash, it prepaid $500,000 of the note in January 23, 2019. In February 2019, L completed a $3 million bond offering. L will use the bond offering proceeds to pay the note payable at its maturity and to pay the construction costs during 2019. On March 13, 2019, L issued its 2018 financial statements. What amount of the note should L include in its current liability section of the December 31st, 2018 balance sheet? All right, so this is one of those items where it's a short-term note expected to be refinanced. And the rules are, if you have the intent and the ability to refinance, and you can demonstrate those things, then you can move the entire amount over to long-term liabilities. All right, so you might think the answer is A, 0, because we would totally refinance that, and therefore we're going to show that as all the long-term liability. However, one little twist in here is that it prepaid $500,000 of the note. So that means they used cash of $500,000. So GAAP states that the amount excluded from current liabilities through refinancing cannot exceed the amount actually refinanced. We'll say, so we're good there. They should consider the $1 million paid by the refinancing to be a long-term liability, and the $500,000 that we actually paid in cash as a current liability. So therefore, the answer is B. And the other big thing of this problem is the refinancing was completed before the issuance of the financial statements. Meets both criteria, intent and ability, for the reclassification. In other words, they knew about paying the $500,000, so they know that that's going to be a current liability. So normally the answer would be 0, but because of that quirk that they actually paid off using current assets, that we would put that amount as a current liability. Number 8, other things being equal, most managers would prefer to report liabilities as non-current rather than current. The logic behind this preference is that long-term classifications permits the company to report what? Well, we can rule out A because it has nothing to do with inventory turnover. And we also do not want, we can rule out B because we don't want to lower working capital. That's right, we don't want that. So it gets us to C and D. Which one is better? Well, it's got to be C because D says a higher working capital, which we want, higher current ratio, which we want, but this says lower debt to equity. It's true, it is true we want a lower debt to equity ratio. However, by calling it non-current rather than current, it's not going to help that because both of those go into the numerator. Loss contingencies should be accrued in the financial statements only if the likelihood has been incurred is. Well, we know the answer needs to be probable and reasonably estimated, which is exactly what it says in D. The other ones say reasonably possible or remote, and so you can rule those out. It has to be probable and reasonably estimated. And finally, which of the following is a contingency should be accrued? Well, again, it has to be probable and reasonably estimated. A, we can rule out because it says companies being sued and a loss is reasonably possible, so that's not true. The company deducts life insurance premiums from the paychecks. All right, again, that has nothing to do with probable or reasonably estimated. The company offers a 2-year warranty. Expenses can be reasonably estimated. That sounds good. Let's go to the last one. It's probable the company will receive $100,000 in the settlement of a lawsuit. That sounds good, except for receive. That means it's a gain contingency, and that will never be accrued. So you can rule that out, and that leaves us with C. Well, thank you very much for listening, and good luck on doing the homework for Chapter 13. Please email me or come to my office if you have any questions.